What's up everyone, it's Scotty with MoneyVest. So in today's video, we are going to be talking about the situation with the current debt levels over in the United States. There's a lot of interesting charts and data points, lots to unpack in this video that we are going to talk about. As always, if you enjoyed this video, find it helpful, make sure that you drop a like and subscribe to the channel. I would really appreciate that. Links to our Discord and Patreon is going to be down below if you're interested in joining, and of course getting access to all the members only private videos, and of course be able to engage with over thousands of traders and investors worldwide and get access to all the buy and sell alerts, options alerts, trade ideas. I'm sending out a lot of options alerts right now, considering how much the markets are ripping higher. So selling calls is, in my opinion, one of the best strategies to employ right now, and the success rate is also over 80%. So again, link's going to be down below if you want to join, and also do connect with me on Instagram. My handle is going to be CASWRP. Would love to connect with you there because I do post a lot of behind the scenes, a lot of stories related to portfolio updates, tips and strategies, and of course polls that you can participate in as well. So link's going to be down below. And this right here, the incredible ballooning of U.S. government debt spikes by $1 trillion in 15 weeks to now sitting at over $34 trillion. And interest payments, that's the craziest part, folks. Interest payments threatening to eat up half of the tax receipts, maybe the only disciplinary force left to deal with Congress. So as we know, the Treasury Department continues to issue a lot of bonds so that they can fund their actual deficits. They can continue to spend on education, on defense, on social security, on healthcare, a lot of different plans that they have going on right now. And not to mention the interest payments alone are now almost coming up to half of the tax receipts that they are collecting. So U.S. national debt spikes to $34 trillion plus another $1 trillion in the last 14 weeks. And this has been just an incredible rally for the level of debt. So total debt, $34 trillion, composed of two types of securities, almost $27 trillion in marketable securities that are traded in the treasury market, secondary market, and are held by investors globally, and $7.1 trillion of non-marketable securities that are held by the U.S. government, pension funds, social security funds, and just the government, within the government as well, and individual investors with I bonds and double E savings bonds as well. So marketable securities, $26.9 trillion, that's up by over 2.2 trillion in the last 7 months since the debt ceiling got lifted, and they're held and traded by the global public, from regular folks driving into T-bills to money market funds, bond funds, banks, and of course insurance companies, institutions, financial, non-financial outfits, including Apple and central banks as well. So there's a lot of debt out there, close to $27 trillion that is marketable securities for the U.S. government. So this right here is interest payments as a percentage of tax receipts. So of course we've seen a significant increase in 2023. So that's gone up to over 35% right now, and up to 40% to as much as 50%. We were back at those levels from back in 1984, 1990s, when over 50% of interest payments were of the tax receipts were going towards the interest payments. So that, of course, is just a crazy number. And we haven't seen this level since 1999. We haven't quite seen the 35% of tax receipts going towards interest payments in over 23, 24 years. So this is happening for the first time in over 2 decades, that over 35% of tax receipts are going towards interest payments. This right here is the $1 trillion deficits as far as the eye can see. So U.S. budget surplus and deficits, and this is a projection all the way through 2031. And what you'll notice is the budget and surplus deficit is expected to continue. Of course, every single year, we are expected to see deficits of at least $1 trillion, if not more, for the U.S. government, right? So the least is going to be, I believe, at 1.5 trillion, which is going to happen maybe in 2025 or 2028. But 2031, we're supposed to cross over $2 trillion, but every single year it's expected to accelerate and get even worse. So if you account for, let's say, 1.5 trillion from now all the way through 2031, that's 7 years. 7 years at 1.5 trillions, we're looking at close to 10 trillion added. So that's 44, close to $45 trillion. And then you pile on the interest payments. That's exactly why the projection's coming up to 50 trillion by the year 2030 plus. In the next, of course, 6 to 7 years, the debt's going to be up to over $50 trillion. And then, of course, if you account for the GDP, and then, of course, the debt levels, it's expected to get up to over 200% of GDP. So under current policies, the debt outstanding will grow to over 200% of GDP by 2032. That's what the CBO also estimates, which of course, is not going to be great financial management on the back of from the Treasury Department, the fiscal and monetary policy standpoint as well. So that is definitely something to be concerned about. We are again at 100% level, similar to what we witnessed back in 1940s, 1950s, at over 100%, and this is expected to parabolically go up as interest payments also increase because of higher interest rates and the rising deficits and the funding from the U.S. government. Now, U.S. government interest payments per day have also doubled from $1 billion per day to before the pandemic to now almost $2 billion per day in 2023. So net interest expense per day on public debt 2023 sitting at just under $2 trillion. So that again is a pretty historical number, something that we haven't quite seen in a very long time. And then finally, we get to debt servicing costs that are rising rapidly. So not only is the debt rising, but the debt servicing costs, which is in other words, the interest rates are also rising along with the rising debt. So that, of course, by 2033 is going to increase significantly at close to $1.4 trillion annually in interest payments as well. So, and as a percent of GDP, that's going to be around 3.5%. That's coming from about 1.52%. So more than doubled in the next 6 or 7 years. And finally, debt servicing costs will grow as a share of total outlays over the next 30 years as well. So over the next 30 years, by 2053, the total debt servicing costs, in other words, the interest payments, are going to make a bigger and bigger piece of the overall outlays, which is the total spending from the U.S. government as well. So, I mean, the reason why these are so important statistics and data points is because sooner or later, this needs to be taken care of, right? This needs to be something that the U.S. government takes care of. And there's only a couple ways to do it. Either they drop spending, which of course decreases the standard of living, or they increase taxes to increase the tax revenues so that they can at least have some surplus to pay down the level of debt, the mountain of debt that continues to kind of increase. But as we know, and based on the projections, that is not going to happen. So the end game really is kind of laid out in a much more detail, according to Ray Dalio, that this is going to create a debt spiral, which is not the best situation to be in for any country, especially the country that has this advantage or this privilege to print the reserve currency of the world, as the U.S. does, to print a U.S. dollar, and they're the reserve currency of the world. So, but of course, at some point, it is going to create a little bit of a problem from a debt standpoint, because it's simple financial mathematics, right? If you're spending more money than you're earning, right, sooner or later you're going to go into debt, and that debt's going to continue to increase. Interest on that debt is going to continue to increase, and at some point, that's going to risk default of your credit, of your debt, and as a result, the debt holders are going to start dumping bonds, which is going to potentially lead to higher interest rates, which could really cause a lot of problems. But we're not there yet. This is only these are only projections. Of course, we don't know if this is actually going to play out as what's projected. But the point is, the idea is that this is something that's brewing in the background. Of course, everybody's kind of too fixated on 2024. How's the market going to do? How the market did in 2023 on a year-over-year basis. But this is something that certainly needs attention sooner or later, because this type of financial mismanagement cannot go on forever, right? It's not sustainable. Even Jerome Powell has mentioned this, that this is not a sustainable path for the U.S. government to keep spending more than they're bringing in, and to continue to kind of rack up all the debt with higher interest. And of course, Ray Dalio's kind of detailed this out in a lot more in-depth videos, and of course in his book as well. So let me know your thoughts down in the comment section below. This is perhaps my only concern long-term with the U.S. economy and the markets, even though I'm, of course, mostly invested in U.S. markets. But this is the only thing that kind of is maybe slight hesitation long-term, and what that end game looks like with respect to the level of debt and how the U.S. is planning to manage all this debt and, of course, interest payments that are racking up over the years. So let me know your thoughts in the comment section down below. I don't have all the answers right now because this is a very, very big macroeconomic problem. So, of course, it's going to require a lot of analysis, and a lot of other variables are at play with respect to interest rates, with respect to the holders of these debts. Of course, Japan, China being some of the top holders of U.S. denominated debt. So what they plan to do with their sort of monetary fiscal policy, with, of course, currency fluctuations, their interest rates. So there's a lot of things at play here, a lot of variables that we need to analyze. But the bottom line is, this is definitely something that needs attention sooner or later. Not a big deal right now, but of course, a bit of a problem as time goes on. So let me know your thoughts down in the comment section below. As always, if you enjoyed this video and a little bit of a macroeconomic update, make sure that you drop a like, subscribe to the channel. Links to our Discord and Patreon is going to be down below if you want to, of course, join, be a part of our MoneyVest community. And definitely do check out the Instagram handle. It's going to be CASWRP if you want to connect with me there. As always, happy investing, and I will see you all in the next video.